What's up, you guys? Michael Elefante here. Gonna talk a little bit about how your house is likely not an asset. And this probably goes, in contrary or in contrast to what most people say or you'll read online is your house is your biggest asset. Well, have you ever thought about what that really means or what an asset versus a liability really means to you as an individual? So today I'm going to talk a little bit about that and break it down a little bit and prove that in most cases your house is definitely not an asset, but actually probably your biggest liability. Before we talk, please hit the like button and throw me a subscribe below. It'll just notify you if you choose to get alerts as well on when I post future content. I typically post around once a week. I'm going to try and post more content, maybe 2 or 3 times a week moving forward. So an asset is typically defined as a resource with economic value that an individual, corporation, or even a country controls that will, you have the expectation that it will provide future benefit to you. So an asset is something that in the future can really generate cash flow or reduce expenses. So for the purposes of this conversation, think of an asset as something that puts money into your pocket. A liability, on the other hand, in general is an obligation to or something that you owe somebody else. So a liability, in contrast to an asset, is actually something that takes money out of our pocket. Think of this as, obviously a house that we're about to talk about, but a car or other purchases that you may make on a daily basis as an individual that is taking money out of your pocket. It's what you choose to spend money on, or if you are in debt to a credit card company or a bank, those types of things are liabilities because they're taking money out of our pocket. The biggest misconception is that people will tell you your house is your biggest asset. But if you really thought about why they say that or why that is, you're challenge them into proving how your house is actually an asset. Because for the majority of Americans and for folks around the world, when you buy a house, you're not typically buying the house in cash. And there's other expenses as far as maintenance and taxes on the property and things like that. So in reality, I'm going to talk about how your house can actually be considered your biggest liability, right? And I'll give you first example off the bat. If you were to lose your job today and you have no other streams of income, whether it be through investments, other forms of passive income, rental properties, things like that, no cash flow coming in to supplement all of your expenses, how are you going to pay for your house? Because you're in debt to the bank, right? Let's say you put 20% down on a $300,000 house. So you put down $60,000 and now the loan amount is $240,000. And I was doing the math earlier, so for a 4% fixed interest rate over a 30-year term, the amount you'll pay in interest over that 30 years is $172,486 in interest alone. So at the end of those 30 years, we'll talk about appreciation in a minute because that's what you're going to probably argue as well. If my house appreciates, then it's an asset because I'm going to be making money that way. So at the end of 30 years, you bought the $300,000 house, you have $300,000 of equity minus appreciation, and you paid $472,486 for it. So appreciation. I know you're thinking about this, and this is what I initially thought when I first was looking to get into real estate. And when you are looking to put money down on a house and hoping that it'll appreciate so much over the next 10, 20, or 30 years, so when you sell it, you will make so much money, right? Not always the case. Your house can technically be considered an asset if and when you sell it, but only if it has appreciated high enough to where you actually realize more equity in the sale than you had actually spent on the house over that period of time. And modestly speaking, most real estate investors seek anywhere from a 2 to 5% annualized rate of appreciation over the long term. Especially if it's in a growing city, I get it. Typically, I would budget for a 3% appreciation or appreciated growth over time. But again, you'll hear people talk about investing money in the stock market. So if your annualized rate of return over the long term is 7 to 10%, which the stock market has, stock market S&P 500 index has proven over time, then your money will definitely be better off invested in the stock market than into a house in hopes that the house appreciates enough to where it is going to be financially benefiting you and considered an asset long term. So we're going to argue why your house is actually probably your biggest liability, right? So if you were to lose your job, you probably can't afford that mortgage payment, or at least you won't be able to for more than a few months, assuming that your money is either tied up in retirement accounts or other investments, and you only have 3 to 6 months of emergency savings. And most people don't even keep that much in savings for emergency expenses or living expenses for those 3 to 6 months. So in addition to the principal and interest, we have to account for utilities. We have to account for taxes, insurance, maintenance, HOA fees. And these are just among like the typical fixed or variable costs that you can account for and money that you're putting into a house over the long term. So I'll give you an example. Same example as we just talked about, $300,000 house. Your monthly principal and interest, if it's a 4% interest rate and you put 20% down, will be about $1,145.80 a month. Okay, so estimated utility cost for, let's say, a 3-bedroom house is probably going to be somewhere between $150 and $200 a month. I put $180 in for this example. And then taxes, I just went with Davidson County here in Nashville, Tennessee, which would come out to be around probably more than $2,000 a year, but I just went with the flat number, $2,000 a year, which is about $167 a month. Insurance, how much homeowners insurance is, and it varies based on your insurer and the area that you live in, things like that, but ballpark, I just went with $100 a month. Maintenance, I was just doing some research and was on bankrate.com, which I typically use for amortization schedule calculator, loan calculator, things like that. And they had actually done a study that the average homeowner spends about $2,000 a year on various home maintenance, whatever that may be, and upkeep with the property, things like that. And an HOA, typically folks, live in a neighborhood, or maybe it's a condo or some type of complex that has an HOA fee, and the HOA takes care of various things that the community helps pay for. And typically an HOA will be around $100 a month, I found on average. So all of those costs added up, including principal and interest, your monthly cost is now calculated to be $1,859.80 a month. So taking principal and interest out of that, the total money spent on a house in a given month would be $714 a month. And I got that number by taking the $1,859.80 minus the $1,145.80 of principal and interest, giving us $714 a month. And cost in perpetuity, that is a liability. That's money going out of our pocket, right? Remember, an asset is money, something that puts money in our pocket. So all these expenses are arguments for why your house is a liability. So that $714 a month adds up to $8,568 a year. So think about that over the life of the loan, because if we're thinking, the life of the loan is 30 years and we're going to sell our house at the end of 30 years just to see what our house would be worth and how much we would sell it for, and we will account for appreciation. But so just total money spent minus the principal and interest that we're paying down our loan, we will spend $257,040 over that 30 years just on utility costs, maintenance on the house, HOA, insurance, and things like that, taxes. And taxes will go up as your house appreciates, by the way. We want to account for that in this example, because as the property value increases, the amount you're paying in property taxes will increase as well. So what's the total money that we spent over the course of 30 years? Again, we have our principal pay down on the house, and over the course of 30 years, not including appreciation, that is $300,000, because that's what the loan was based off of. We spent $172,486 on interest paid to the bank. And then lastly, we talked about how much money we spent on things like taxes, HOA, maintenance, and whatnot. And that added up to $257,040. That all adds up to, over the course of 30 years, for our house, our greatest asset, we spent $729,526 for a $300,000 house. That's pretty crazy, right? So I know you're thinking, okay, well, what if it appreciates, 3% annually for the next 30 years? How much will our house be worth? So if you do this, and actually you can just do it in a spreadsheet and just do an annualized rate of return of 3% and see what that growth looks like, the house will actually be worth around $728,179. And I kid you not, this is about $1,000 off of the total money we spent over the course of the loan. As you remember, $729,526, and with 3% appreciation on average every year for 30 years, a $300,000 home will now be worth $728,179. I didn't do that on purpose. It came out to pretty much the same amount of money. So ultimately, you're coming out with not much, you didn't put money in your pocket over the life of the loan or the time you've had the house ultimately to when you sold it for. And that's probably in the best case scenario, right? So again, that's my argument to why your house is your biggest liability. Again, it's something that's taking money out of your pocket each month, even though, yeah, some of it's going toward principal each month and loan pay down. And over the course of time, you will have lots of equity built in the house plus appreciation. Again, that's not necessarily going to be realized once the house is sold because you spent all this money on interest and other things that require upkeep and maintenance, taxes, things like that over time. So this is why investing in real estate is so cool, right? So if you invest in real estate and have rental properties, whether you're doing long-term rent or short-term rentals on Airbnb and other sites similar to that, you are going to have, the loan from the bank, okay? And then each month you're going to have renters paying down the loan for you. And you're going to, the appreciation is just icing on the cake, but then you're going to have not just the loan pay down, but you're calculating how much to charge per rent each month or per night on a short-term rental in order to provide, a pretty substantial amount of cash flow to you each month. So not only is somebody else paying down the loan, it's an asset because it's something that's putting money into your pocket, right? So at the end of the day, remember, consider things such as a home or a rental property or whatever it may be. It's an asset if it's putting money into your pocket, and it's definitely a liability if it's taking money out of your pocket. Thanks again for watching, guys. I really appreciate you guys taking the time to watch and your support. I've had a lot of great positive feedback, and I'm looking forward to posting more content. I'm hoping to post more than once a week, maybe up to 2 to 3 times a week. Please hit the like button if you subscribe below. It really means a lot to me and will help me further grow my platform and produce more content that is relevant to you all. But thanks again for watching, guys, and we'll see you next time.